This might be one of the most controversial videos on this channel. We're going to talk about one of the largest investment classes out there. We're going to talk about an investment class that has a lot of allocation by the richest people on this planet, like Warren Buffett. And we're going to expose how that investment class is actually a scam. The topic of this video is how the US bond market is distorting all asset classes. That kind of distortion also led into the creation of Bitcoin. It has very far-reaching effects. Now here's the official narrative. What we see in green, that's the officially measured inflation rate since 1972. What we see in red, that's the target interest rate. And there is a connection here, as in when there's a lot of inflation, there tends to be also more interest that's getting paid. When there's less inflation, then the interest rate is coming down. And for the last years, roughly 25 to 30 years, we have seen more inflation than interest rate. In other words, there was real monetary purchasing power loss by buying into bonds. Now we can calculate the delta, then we get this. This is now the interest rate minus the inflation rate. And while this wasn't the best deal in the last 25 years, if you look at this historically, the average real interest rate was 1.1% for government bonds. So the official narrative is that when we lend money to the US government, we should be getting more purchasing power over time. We should be making a profit. That profit is called the real risk-free rate. And it's one of the reasons why pension funds, etc., allocate towards US government bonds long term. But this story is false. Government bonds burn money. They don't create any real return. And this is what forces the broad masses into risk investing. That's why property is so expensive. That's why tech stocks are so expensive. And that's why Bitcoin gets all of its adoption. If there was an investment vehicle that has long-term real returns, where we actually make money without any risk, then people would simply just park their money there. And it was the official story of US government bonds, but now less and less people believe the story. When we average out the interest rate over the last 50 years, we got nominally a return of 5.4% per annum. It's currently less than the historical average, but still, that's the official narrative. But then, interestingly enough, the monetary base is expanding faster than that. It's going up on average by 6.8% every year. So the supply of something is increasing faster than the return that we are getting. And that's a fundamental problem. That's why there is no real return. The base is growing faster than the return, so the bondholder is long-term getting diluted away from their purchasing power. Now, Bitcoin intended to solve this, and to a degree it does. And we are going to talk about this in a second. But what I find interesting is that the crypto market as a whole, besides Bitcoin, actually does the exact same thing, just on an accelerated manner. Have a look at a random altcoin. Here, for example, DYDX. We've got a staking program. So people are incentivized to stake their tokens in order to get a return. But then at the same time, we see how the supply expands over time. Now it expands here at a much quicker rate compared to the fiat monetary base, but still it's going up. So people are incentivized to lock up their purchasing power, to stake it, so that then the team and the early investors, they can dump on those stakers. They can take out the value from the system. And so the exact same thing is happening with the fiat currency system, as in people are incentivized to stake their dollars, to invest into bonds, and they do get a return, but the return isn't as quick compared to the expansion of the tokens, of the number of US dollars that are floating. So who's benefiting from this? All the people that actually get those new tokens. So in crypto, that's the early investors, and the team in the fiat world, that's everybody that's taking on debt. So that's fundamentally how the monetary base expands over time, right? Everybody that buys a house and takes out a mortgage and potentially pays very low financing costs for that, those people, they tend to get their debt devalued over time. And if the financing cost is lower than 6.8% per annum, then that's a profitable business. The masses see their purchasing power eroded. Everybody that has plain cash, of course, loses massively, but even the bondholders, they lose over time. Again, by that delta. The delta of whatever currently the interest rate is, and historically it's 5.4% relative to the monetary expansion, which is 6.8%. So even the bondholders, they lose 1.4% in purchasing power every single year. Now we have to be a bit more precise here what we mean by purchasing power, because there is of course the official inflation rate, and that inflation rate measures consumer prices. Now, consumer prices on the base of it tend to actually be deflationary over time. Because there is technological progress, we do get more efficient over time. It's easier and easier to produce that TV, to produce that phone, to produce whatever consumer good. And because of that technological progress, if we had a stable monetary base, the prices of those things would actually go down very, very rapidly. But because the monetary base is expanding by 6.8%, we do see consumer prices going up by only 3.1%. And so many altcoins are just the exact same thing on steroids, right? We stake, we get an expanding supply, and then of course the value of that thing to the benchmark goes down. This is now DYDX relative to Bitcoin. But the exact same thing can also be used for the fiat ecosystem. Now we always have to think about what's a realistic benchmark, right? For DYDX, because it's a cryptocurrency, we could look at Bitcoin. For the fiat ecosystem, maybe we could look at other forms of money. So here's the value of $1 relative to gold. Or here's the value of $1 relative to the S&P 500. Or here's the value of $1 relative to the average house. So this is now the house price index over the last 35 years. This year is the global financial crisis when the US dollar actually gained against houses. And so I believe most people haven't really understood what this means. When we lose our money by investing into the risk-free asset, if we lose our purchasing power long term, we are forced to invest into something that keeps its value to a degree. And that's why I believe all asset classes are going up over time. This is not investing. This is not making money. This is just preserving purchasing power. Now, Satoshi Nakamoto saw this. Bitcoin was created at the height of the global financial crisis. This here is the S&P 500 relative to the money supply. So first we saw the .com bubble burst. Then we saw the global financial crisis. And this is where Bitcoin was born. So throughout Bitcoin's existence, we never really saw a real crisis. And so Bitcoin maxis, they say that Bitcoin solves this. Now this is already true for all the other asset classes, right? Gold to a degree solves this as well. Property solves this as well. Stocks solve this as well. Bitcoin is just another option to buy something that doesn't devalue over time. But there is the same problem as with other asset classes. We do have our volatility. Now the great thing about Bitcoin's volatility is that it tends to be not that correlated to the traditional finance ecosystem. Recently, the correlation is going up, but especially in the early days, Bitcoin had very little correlation to traditional finance. And so it was a good addition to protect ourselves against the continuous devaluation of the US dollar. Now the reason why Bitcoin still outperforms most other asset classes long term is not because of its volatility. Altcoins also have a lot of volatility. It's just because of the long term adoption, as in the supply is getting stacked away faster and faster. Here is the Bitcoin that has not moved for the last 5 years, and it tends to be a growing fraction of the entire supply. Because of that, even the theoretical supply expansion of BTC through the Bitcoin mining is not really a problem. We see continuous purchases through the ETFs and through the treasury companies, and more Bitcoin gets lost. And so Bitcoin really is the hardest of the monies. It expands in supply only by 0.84% per annum. That's less than what Bitcoin has. It's obviously also much less than what fiat currencies have. Now, both the altcoin market, but also the fiat currency system is inherently unfair because there are a few insiders that understand the system, that take away value from all the rest, and thus over time we tend to see more and more capital concentration. Now, there can only be that much capital concentration until the system breaks. For example, as the debt to GDP ratio grows further and further, more and more of the tax income has to be paid to the people that own the bonds. Now, the bondholders, they don't really make any money, but they do get more and more of the supply expansion. And so what happens over time is, as the capital concentrates more and more, there's more pressure to expand the fiat currency base even further. And then the question is, what's going to happen? Who is actually going to lose their money? I'm currently reading the book Broken Money by Lynn Alden. I can very much recommend that book. It goes through the history, it goes through what actually happens as the nature of money changes over time. Now the problem is, as capital concentrates further and further, political tension tends to rise as well. And that then leads to political changes. Those political changes can include taking away the assets from the people that have it. There was a time where it was illegal to own hard money, where it was illegal to own physical gold. It was illegal because it couldn't get taxed as easily, right? For the people that own a house, we can simply increase property tax. For the people that own stocks, we can also just increase taxes on gains. But for gold, it's not possible. And so that's why I think it's very, very important to own the Bitcoin in self-custody, to own this via a hardware wallet and not just via an ETF. Yes, short-term, owning an ETF might make sense just to get some price exposure, but who knows what happens when political times get very difficult. We don't really know what kind of laws will get passed in order to reduce capital concentration. The easiest way to distribute some wealth and reduce capital concentration is to just print more US dollars, thus taking away all the capital from the bondholders. But it might not stop there. We could also see a big change in home ownership laws, or in laws regarding gold, or in laws regarding cryptocurrency as well. So really, it's best to just self-custody for any allocation that's very long-term. Don't trust a third party, don't trust a potential single point of failure that could be attacked by the government. Besides all the medium and short-term price movements, it's also always interesting to see what happens long-term. What kind of assets can we actually hold over the years? Because once we know that, we know what to do during times of potential sell-off. I think, for example, that there's no question that Bitcoin long-term will appreciate in US dollars. Have a look at the percent of Bitcoin supply that has not moved in the last 5 years. This fraction tends to increase long-term over time. So there's less and less Bitcoin that's available for active trading. At the same time, we see more and more Bitcoin getting purchased by the treasury companies. And we've got the ETFs on top of that. So one might argue that roughly 30% of Bitcoin supply is in the diamond hands, or it's completely lost. At least net, this chart is unlikely going to go down significantly. We've got more than 5% in the hands of the treasury companies, and we've got roughly 7% of the supply held by the ETFs. So that means more than 40% of Bitcoin supply is in the hands of entities that tend to just stack away their Bitcoin over time. All of those curves tend to go up over time. They tend to not go down. And again, this reduces supply. This increases the value. Yes, there is Bitcoin mining of 0.83% per annum, but that mining is much slower compared to the rate of lost Bitcoin or of accumulated Bitcoin through the treasury companies or through the ETFs. And so this is where crypto, and especially Bitcoin, differentiates itself from other asset classes. For many other asset classes, we see as prices go up that it's mainly the short-term investor that wants to make a quick buck. But we can see with the Bitcoin rally from recently 16K to above 100K that it's the long-term holders that tend to just accumulate over time that are causing the rally. So that's what we want, right? We want that the people that buy an asset, they're not selling it anymore in the future, at least in aggregate. And this is, I believe, what we see with Bitcoin. And so I don't think it's a real question whether or not Bitcoin will appreciate in the future, especially versus the US dollar, because the US dollar has an expanding supply. It tends to grow by roughly 6.8% per annum. So this is USM2. This is official numbers by the Federal Reserve. If we look at the money supply in 1959 and compare this with the money supply today, within 60 years, the monetary base expanded by 77x, which is an annual growth of 6.8%, which, by the way, is the majority of the return of the stock market as well. Most of the stock market return is just monetary debasement. And so when Bitcoin becomes more and more rare over time because of those entities, and the fiat base grows more and more, then the most straightforward approach would be to simply use the same kind of investment tactics that we have for other asset classes, right? For the stock market, for example, we've got our savings plans, our 401ks, or for property, we've got our mortgage payments, where again, we pay in regularly with our cash flow. We can do the same for Bitcoin. For Bitcoin, it's typically called dollar cost averaging. So for example, if we buy $1,000 worth of BTC, and we do this for the long term, as we do with property and as we do with the stock market as well. If we just expand our time horizon to say 6 years, so beyond a cycle typically for Bitcoin, then it's extremely likely that over time we are outperforming classical investment approaches, because again, Bitcoin becomes more rare over time and it still gets more and more adoption. Had you followed this $1,000 per month approach with the S&P 500 or with gold, and you did this for 6 years, you'd be at somewhere around 120, 130K now. Had you done the same for Bitcoin, you'd now be at 360K. So roughly 3x the amount. And so this is where Bitcoin differentiates itself massively from the altcoin market. With the altcoins, we do not know what will be around still in 6 years, what will still be relevant in 6 years. The altcoins are highly inflationary, as in projects issue new tokens over time so that venture capitalists can sell their tokens, so that the team can sell their tokens. There are vesting unlocks. And when we look at the entire market, the entire altcoin market that's tracked here on Tokenomics AI, we've got unlocks of roughly 1 billion per week. So as long as we don't see 1 billion of purchases every single week in the altcoins, the prices of the altcoins are going down. Now, how much is 1 billion per week? Let's compare this with Bitcoin. Bitcoin has a market cap of 2.27 trillion and it's got an inflation rate of 0.83%, which by the way is debatable because again, we've got the purchases by all of those other entities and we've got the Bitcoin that gets lost. But let's ignore all of this. Let's just say this doesn't exist. Let's say we really have a net issuance of those 0.83% on the 2.27 trillion. If we run the numbers, we've got selling pressure of 371 million per week. So roughly a third of what the altcoins have as selling pressure. Now, how likely is it that the altcoins in aggregate get purchased at 3 times the rate of Bitcoin when Bitcoin already has this direct link to Wall Street? I think the likelihood is rather low. On top of that, the Bitcoin market cap is roughly 7 times the market cap of the altcoins. So the selling pressure is only 1/3. The market cap is 7 times as large. So really, relatively speaking, the altcoins have an inflation rate that's 20 times larger. And that's what's causing this situation. This is the smaller altcoins, the performance in the last year. Bitcoin has roughly doubled in the last year. And just have a look at how many altcoins that are shown here have doubled. There's 1, 2, 3 altcoins that did roughly the same as Bitcoin. There's only one outperformer. The rest all massively underperformed. And this is not a coincidence. This is simply just capital concentration towards the long-term winner in the market. You can't buy Quick or Myro or Pika or Atlas for $1,000 every month and just use this as another savings vehicle. Dollar cost averaging into those assets doesn't make sense, but dollar cost averaging into Bitcoin or Ethereum very much makes sense. And so I'm taking advantage of this capital concentration process. I'm betting on most altcoins doing worse than Bitcoin over time. And that's how I create additional alpha over just buying and holding Bitcoin. I don't just dollar cost average into Bitcoin, I dollar cost average into my trading portfolio, and I buy Bitcoin and Ethereum and Solana, and I sell or short sell all the bad altcoins over time. So this is my active trading portfolio measured in BTC. And of course, there is a lot of dollar cost averaging happening here as well. There's additional capital that enters this portfolio every month. But had I not dollar cost averaged at all, then because of my relative valuation trades, I still doubled the money. So without the relative valuation trades, my portfolio would now be only at around 2.5 Bitcoin instead of 5 Bitcoin. That's the kind of impact that's doable after 4 years of following such a strategy. So basically take this DCA approach and just 2x that capital. That's then 720K versus just having around 100K doing a traditional S&P 500 savings plan. Have a look at Arbitrum, for example. This is the number of ARB tokens over time that are circulating. When the supply expands and the demand doesn't expand at the same rate, then the price underperforms. Now, this is Arbitrum in US dollars, and this already doesn't look that great, right? We have seen Arbitrum going down by 60%. But compare Arbitrum relative to Bitcoin, it's much, much worse. Again, because Bitcoin has all of those inflows from traditional finance, and because a lot of Bitcoin gets lost over time, and because Bitcoin does not have this ultra aggressive supply schedule. The number of Arbitrum tokens is expanding faster even than the number of US dollars. And that's why it's losing even against the US dollar, but it's definitely losing against Bitcoin. And so my approach to generate alpha out of this is to just flip this chart around. So instead of looking at ARB relative to Bitcoin, here's Bitcoin relative to ARB. So we're going short Arbitrum, we're betting on falling prices of Arbitrum, we're betting on rising prices of Bitcoin. And what we see in orange, this is just the Bitcoin price during the same time. So we outperform buying and holding Bitcoin massively with that strategy. For example, over here, since the beginning of 2024 to today, Bitcoin has appreciated by 164%, but Bitcoin relative to Arbitrum has appreciated by 678%. Now, this is way higher than the alpha that I personally achieve, but of course, I'm also rather risk averse. I don't bet the entire portfolio on a single token, and not everything that inflates as aggressively tends to also lose that constantly. But again, it's all about the long term. It's about building wealth over several years, not just speculating on what's happening next week. Now, granted, betting on relative valuations, so something going up while the other thing is going down at the same time, is a bit more complex compared to just buying an altcoin straight out. But that's why I made dedicated videos on the topic. There's actually only 2 videos that you have to watch. So there is this one over here, using perpetual futures to bet on relative valuations. And there's this one over here, risk management with relative valuation bets. It's 1 hour in total worth of content. And after you've watched that, you know how to set up positions like this. Now, there are bets that are a bit more risky than others. Arbitrum is rather risky. Just have a look at this drawdown here. But there are also more constant winners. For example, have a look at this. This is Bitcoin relative to Balancer. Balancer, again, being a very inflationary token. Here's my offer. You watch those 2 videos, you learn how to set up those relative valuation trades and how to do the risk management properly. And then afterwards, after you've joined the community, I will send you my favorite trade. So I've got several of those relative valuation trades open, but I will send you my favorite one. And if you don't make money with that favorite trade after 1 month of holding that relative valuation trade, then I will just refund you the membership fee. So this video over here and this video over here. And if you don't make money with that favorite trade, you will get the $125 back. That's the fee per month. I, of course, share every single trade that I make. I don't just share my favorite trade. I share all the trades that I make in real time to the premium members. A link to premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.